Hey traders, this is Blake Morrow with Trader Summit, and I have our weekly show with Mr. Jim Welsh of Macro Tides. It's good to see you, Jim. It's been kind of a crazy week. Here we are, right back at 4150 in the S&P.
Gee, it seems familiar. I think I looked up this morning, April 3rd, the S&P hit 4133. So it's been a lot of choppiness as you have competing forces at play. The economy continues to be okay. Therefore, earnings have been okay and probably better than some people expected. At the same time, the Fed, I think, is going to raise rates again, and you still have the lingering concerns and problem with the regional banks.
Yeah.
So it's a big tug of war. I think that will get resolved in the second quarter. I mean, we're already in the second quarter, but I mean, by the time we get to mid-year, I think that's going to get resolved. Maybe not in a
Tell
way
me where. Tell me how.
Well, we've been talking about it in terms of the likelihood that and it's kind of like a metaphor in the sense that on one hand we have all these very reliable recession indicators, the inverted yield curve being extraordinarily inverted, leading economic indicators which fell for the 12th consecutive month, have never dropped this much in a 6-month window of time going back 50, 60 years without a recession. Bank lending standards at the end of the fourth quarter tightened enough, they're going to get even tighter. So you have all these very reliable indicators saying a recession is coming, and people are like, well, it's not here. Maybe it's not going to happen. And I think the main reason, as we've talked and as I've written, is consumers had a huge pile of savings in 2022 and coming into this year. Wage growth, Social Security benefits going up 8.7%. In other words, there's been an injection of liquidity ongoing organically to some extent in the economy, which has sustained consumer spending. Yeah. And it continued in the first quarter. And so to me, does that change the outcome? I don't believe so. Has it pushed it back? Yes. But I think as all these factors start to weigh on the economy, especially lending standards over the next 6 to 8, 9 months, I think we're going to be in a recession before the end of the year, or at a minimum, a really significant slowdown with at least 1 quarter of negative GDP. And then I think the risk of a hard landing developing have indeed gone up, which I'm reading the May macro tides, primarily tied to commercial real estate, small banks exposure. They represent 67% of all the lending to commercial real estate. Well, if you look at some of the declines that have taken place with office properties down over 25%, even apartments down 15%, there's been a huge hit. So as loans come due, and there's $1 trillion worth of loans coming due over the next year, what's going to happen? Well, at a minimum, the rates on all those loans are going to get ratcheted up a lot.
Yeah.
And, some of the properties will have lost enough value that the lender won't renew the loan, which then you get defaults, people walking away from properties. That's the shoe that'll probably happen next year, because the lag of time of, somebody gets their loan comes up or lease comes up in a month or so, and then somebody else's obviously is 3 months, 5 months, and so forth. So it's kind of a slow motion thing, but over time, I think that's going to weigh on commercial real estate prices, which is going to be a big hit to the small banks, their capital bases, and guess what? Deposit outflows, they're going to continue, and in some cases accelerate. So to me, these problems are, kind of like a small fire that people aren't maybe fully recognizing that they haven't put the fire out, and 6 to 12 months from now, they're going to become even more intense and problematic for the economy. So that's what I kind of see down the road. In the short run, you still have the economy okay because consumers have the ability to keep spending, but it doesn't change, I don't think, the longer term trajectory of what's coming.
All right. Well, speaking of which, kind of some backward-looking numbers, a GDP chart you brought. Let's take a look at some of the information and some of the charts that you brought to us this week, Jim. And what is this chart about? And explain to us what we're looking at.
So these are the categories within the GDP report, and you can see the bar that's in orange, 1.1%. The bar right next to that is consumer spending. So what we just talked about is, hey, consumers have the wherewithal to keep spending, and they are. Now, granted, did spending slow as the quarter went on? Yes, but in aggregate, it was pretty healthy, right? Then the far right is inventory adjustment, and trade are the two things you have to kind of the boogeyman within the GDP report. So last quarter, in the first quarter, inventory subtracted 2.3% from GDP. It's kind of like in the mid-year last year where we had some negative GDP reports that were because of trade and inventory. So the point being is final sales were decent, consumer spending is decent, and think about what happens. Retailers work their inventories down. At some point in time, some of what they've gotten rid of, they will have to rebuild. And so what that implies is you're going to get some additions to GDP in coming quarters that will at least make up for part of the 2.3% contraction. So when you think about it, the headlines were GDP slows from 2.6 to 1.1, and people walk away with, gee, the economy is really slowing. My point is, wait a second, it's still holding up better than maybe a lot of people realize. And, as I said, I think as we get closer to mid-year and beyond is when, the more pronounced weakness is going to make an appearance. So in the near term, what does this mean? Well, the Fed's going to look at these numbers and they're going to say, yeah, I think we're going to raise the funds rate to 5.1. There's a lot of reasons why. Bullard back in November did a projection for the funds rate based, I think it was the Phillips curve, from 5% to 7%. And lo and behold, what happened in December? What was the median projection for the funds rate? 5.1. Same thing happened in March, 5.1. So to me, there should be no doubt that they're going to go to 5.1. I've been consistent in saying that. But I do think that the Fed's going to hit the pause button. Are they going to communicate that clearly? I don't believe so. They want the optionality to remain, where if the data continues to come in stronger, inflation doesn't fall as much as they would like to see, it leaves open the potential that, okay, we may have to raise rates when we get to June, and we don't want to close that door prematurely. So I think that's the strategy that they're going to employ. And, at the same time, do I think the odds are that the Fed will stop after this increase in coming at the next week? I think the odds are rising. They're not stupid. They know that lending standards they're kind of like carbon monoxide. That's the analogy I'm using in my macro tides. You can't see it, you can't smell it, but it could be deadly. Yeah. And lending standards are going to continue to increase, which will slowly but surely deprive the economy of liquidity.
So in your view, you expect the Fed this next week to raise rates by 0.25%?
Yep, because that'll get them to the 5.25 range, which is, what's the midpoint of that? 5.125. Yeah. So yes, but I also don't think they're going to clearly signal that we're done. They're going to keep open where we're data dependent. Every meeting is a live meeting. Inflation isn't down. The economy continues to be okay. So that's going to collide with the idea that, again, the Fed funds futures have been doing this consistently, where they're looking for 1 to 2 cuts in the back half of this year. Now, the Fed has said we're going to 5.1 and we're keeping it there. So to me, this is the adjustment that markets are going to have to make at some point in time, is accepting and realizing that, oh, wait, they're serious. Powell and company have repeatedly said, we don't want to repeat the mistakes of the 1970s. The first mistake was raising the funds rate too aggressively and causing a recession. So
didn't they already make that mistake?
They may have. They probably have. I mean, there's other things going on.
Right.
But my point is, the game plan that they've adopted is we get to a level and then we're going to hold at the level. We're just not going to keep raising the funds rate until inflation is down to 2%, because that's not going to work. Because the flip side then was in the 70s, they went too far, economy went into recession, they had to lower rates. So they're going to be reluctant. And Powell has said many times, the biggest mistake would be to lower rates prematurely. So what does that mean? It means that in the face of data that starts to show, yes, the economy is slowing significantly, which I think will start to show up as we get past mid-year, the Fed isn't going to immediately run in to say, okay, we're going to help now, we're going to cut rates. They're not going to do that. They're going to resist that. And I think that's the vulnerability the market faces. The last 20 years, the Fed did do that. The market expects them to continue to behave that way. And yet, with inflation coming off a 40-year high and working its way down, especially the core rates kind of gradually and slowly, they're just not going to ride to the rescue. And that's why I think the market is still vulnerable for another pretty good sized decline that will retest the lows of October at around 3,500 and has the potential of getting down towards 3,200 for mathematical reasons. Okay. I keep thinking that we're going to get one more pop. We're going to get one more pop. So we had this pullback. The S&P did get below 4,070. I thought that would kind of be a bad thing if it did, but look at the bottom panel. It's a measure of how oversold the market is. So what I did is I combined the RSI, which is an indicator a lot of technicians are familiar with, and the MACD. I find it to be more, clearer. But you can see prices were, the MACD was more oversold early this week, midweek, than it was back in mid-March. So to me, it's like, hey, good earnings coming from the mega cap stocks. The Qs are going to rally. That's what I wrote in my last Monday's weekly technical review, that the Qs were set up, that these mega cap stocks were likely to rally, and that's what's happened. And I think at a minimum the S&P is going to make a run at that 41.95, which was the high the first few days of February. As I point out, the 618 back up. From the high in January of 2022 to the low in October, the 50% retracement was 41.55. And we started talking about, hey, the market's done nothing for weeks. Well, what's it been bouncing around? The 50% retracement. So if the S&P gets up and then above 4,200, Blake, there's going to be a lot of stops above that level. There's also going to be people saying, hey, the market is telling me that there isn't going to be a recession, because the markets discount the future, don't you know? Now, the same people conveniently forget that when the S&P made a new all-time high in January of 2022, it was right before a 20% plus the correction. But never mind. So anyway, I just think the table has been set for one more push higher based on the fact, geez, the economy just isn't breaking down. Earnings are still holding up really good. The consensus on Wall Street is for earnings to go from $50 and change in the first quarter to over 58 in the fourth quarter. So all this stuff kind of feeds that narrative, which keeps selling pressure at bay. And that's kind of what we've seen the last 3 weeks.
It really has.
Selling pressure didn't pick up.
Yeah. Well,
so I'm looking for a place to go short. I'm looking for a place to go short. In other words, after this push is over in the S&P, I think that's a shorting opportunity. What I don't know is it at 4110, 4210, pardon me, or 4300. I don't know. I have to wait and see. Okay.
Well, and what's that going to do to the dollar? Because the dollar is trying to forge out some lows, but I would assume if stocks continue higher, the dollar should go lower, right?
Well, we'll see. Again, the reason why the dollar has sold off the last month has been the idea that the regional banking crisis is going to keep the Fed, at bay. Grudgingly, it's like, okay, I guess they will go one more quarter point, because 3 weeks ago, no, they're not even going to 5.1. But that they're going to cut rates in the second half of this year. So my belief is the Fed is not going to cut the funds rate. Think about it. The unemployment rate is at a 50-year low, basically, at 3.5%. Powell has repeatedly said the labor market holds the key to monetary policy, more so than inflation. Is the Fed going to start cutting the funds rate with the unemployment rate near a 50-year low? There's no way. At least in my view, there's no way. So my point is the markets are anticipating the Fed to become easy in the second half of this year. And I think when that gets disproved, the dollar gets a bid.
Okay, so
we know where the fault line is, Blake. Obviously, you get much below this last two lows, I'm wrong.
Yeah, right.
That's simple.
Yep. Okay, so gold here. What are you seeing with gold? Because we haven't done squat this week.
Yeah, no. Again, the big thing for me was 5 up from last September. So longer term, that's bullish because that's like, okay, after a pullback, there's another push coming. That's my take. Now it's a question of how much of a pullback. And chart wise, as I noted, 1920, 1900 seems reasonable. The 382 retracement of the rally from the September low to the high we saw a few weeks ago is around 1880. So to me, it's just setting up to, all right, if the dollar stiffens a little bit, gold, I think, backtracks. Because I think the gold market is also kind of factored in the idea the Fed's going to cave in and cut rates. So I think, to me, that chart looks like gold's ready to puke.
All right. Well, let's see if it does. And, if we get below 1900, maybe that is a buying opportunity. And it sounds like your views about the bond market are still the same.
Yeah, they are. I mean, I just think that from the low last October with TLT and when the 10-year and the 30-year hit their highs in terms of yields, that you had a wave A up from that ended in early December, then an ABC down to the lows of late February, and we're in the beginning part of a wave C rally. Wave 1 up, we're chopping sideways. And I just think the TLT is going to break out above 110, above all these highs. And if it does, the measured move, it rallied $16 or so, $17 from the low September to the December high. You add that to 98.88, you get something around 116. So I think that's what's coming. And again, part of that is predicated on we are going to continue to see inflation come down, but more importantly, the economy is going to show more signs of weakening. And now the pattern allows for a dip below 103.48. If it happens, I would say be a buyer. Would have stopped. I think I had it like at 101.60, something like that. Yeah. So that's what the charts are, kind of implying. And again, the idea here is to try to combine the outlook for monetary policy, the economy, with technical analysis. And that's kind of what we just went through.
Yeah, it is. Jim, next week's going to be a big week with the Fed. We have jobs report too. So we're going to be talking right after the jobs report. Let me ask you this before we go. I know you're expecting the Fed to raise rates a quarter point, 25 basis points. That gets them to their terminal rate, if you will. Yeah. They're going to leave the door open for maybe further hikes if needed. But what's the jobs picture look like next week in your view? Is next week, is this the month that we start to see the jobs picture change, or do we still have a few more months of growth?
We have more months of growth. I mean, the employment number is the tail. It's the last thing to go. And as we've talked really for numerous times over many months, employers, after struggling so hard to get employees, I mean, they're always reluctant to let people go. They cut hours, they get rid of overtime, they get rid of temporary workers, and then they let somebody go. That finally happens is when revenue starts to be weaker. Now I got to really cut costs. Oh gosh, I'm going to have to let somebody go. So to me, the jobs number is a fourth quarter to first quarter of next year's story, where we'll see that change. So, I think this next number coming out is going to show more of the same, a gradual slowing in job growth.
All right. Well, Jim, we appreciate you each and every week here. If you guys and gals like what Jim does, make sure you give him a thumbs up. Subscribe to the channel down below so you don't miss any of these weekly shows that we do together. And make sure you jump in the comments too if you have some opinions about what Jim said. Jump in there and tell them how you feel. So, Jim, I want to thank you for being with us. And how do people learn more about macro tides?
Macrotides.com, or send an email to jimwelshmacro@gmail.com, and I'll send you a recent publication.
Great. We appreciate you, Jim. Look forward to speaking with you next week.
You got it. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.